Welcome, traders out there in Traderland. Welcome to this installment of the 2011 Year in Review. My name's Des Woodruff, president and founder of freetradingvideos.com Incorporated, doing business as Grok Trade. I'm the senior analyst here and also potentially your future trading mentor. I'd like to start off talking about the year 2011. We have a lot to go over, and I think this will be a video you will want to comment on and also share with a friend, so please feel invited to do so. We're going to go over a few things. Quick overview of the year, technically speaking, and a thorough review of the technicals on all major broad markets, and then technical review of the financial markets. We're going to get into a technical review of gold also, and we're going to review the sectors and their rotations. And first and foremost, we're going to take a look here at the S&P. Stocks rose early in 2011 on hopes for a strengthening economy recovery in the U.S., only to plunge in the second half of the year when that recovery stalled. And frustrations with political dysfunctions in the U.S. and fear of an economic meltdown in Europe did contribute to the downturn in the last part of the year. In the end, the markets finished the years right where it started, and I want to show you this technically speaking, looking at the weekly chart on the SPX. And this is 2010 down here, and we're starting January 2011. That's that big green line coming up. And we start out at 1257. So remember 1257. 1257 is where we start off 2011. By the time we end January, we're up 2.3%. As we get in further into the year, April, we top out and we're up 8.4%. From April on, things started getting hairy. Chop around and then a major crash. You can see this green line. That's where we started out the year. We did crash below that in the 50-week moving average. Again, each bar is a week. We come here, we hit an area, find support, we bounce with a hammer. But if you look at the beginning of August, we're down 11%. Remember, at one point, we were up 8.4%. Find support, we rally higher. We get above the green line, which is where we started, but promptly drop again, finding support again, popping back up, coming back down, popping back up, and we end the year right here. That's the big red line, and we end the year at 1257. I'm going to scrunch this back up. We started the year at 1257. We end the year at 1257, and a lot of turbulence and volatility between the beginning of 2011 to the end. Again, we started off very strong when those economic hopes had dried up, and after such an extended run, it's time to give back some. We had a head and shoulder trend reversal pattern. We did drop. We get a little double bottom type pattern right here. We head back up, making higher swing lows, higher swing highs, but we're at break even at this moment. I'm going to zoom in here and go to a daily chart. Now we're going to be going over a lot of technicals here, so bear with me. Daily chart on the S&P. Every candlestick is a day. If I zoom in and bring in a lot of data, you can see these two big trend lines. This one starts way back here in 2007. We hit here in 2011, and it makes for a major trend line. Back here, we come in at 2009. We hit again right here in 2011, and we get this big pinching formation. If you look at these two big lines, you get a huge symmetrical triangle. If you zoom in, you have another set of symmetrical triangle lines here, here, triangles build up power, strength. It's like a coiling coil that builds up power, and it's going to want to break out or down. Right now has a really good chance of breaking out to the upside just because the daily chart is building a high base above this resistance line. We're over resistance now, it's acting as support. Anytime you build a high base, that is bullish, and that could get really bullish. But we do have major resistance coming up when we hit this area. The weekly chart. We were just looking at this chart. What we have, those two big trend lines and then those two smaller ones here coming up. We are breaking a resistance area, and we're fighting the 50-week moving average right now as we speak. We need to get more legs, and we need to start heading northbound on the S&P. This is the monthly chart. I want to show you this. We have some ginormous, huge trend lines here. These big ones. This one actually goes back in testing 1990. 1990, and then we come up and we smack it right here, 2009. Huge triangle, but we're at the resistance part of this triangle. If I zoom in here, we have lower highs, higher lows. We have a pinching taking place. Here in the last 3 months, gang, it's just been flat with a lot of turbulence in between. Very, very flat. So the markets are looking to make a major move. That's what you can bank on. It will not be an insignificant move, and it will be a multi-legged move, either another large up leg, multiple months heading higher, or you're going to see multiple months heading lower, like here and here. That is expected sometime fairly soon. If we get over this resistance area, say 13, if we can get over 1350, that could be really, really bullish. If we start breaking down and we start dropping below these areas, say if we get to below 1120, that could be really, really bearish. Anything between could just get squirrely. If I look here at the Dow, this is the Dow monthly. Support, support. Now support is resistance. We have a major resistance line coming across. You can see this here. Support, support. We come over here, resistance. So we're making higher highs, higher lows. We do have a hanging man right now at a major resistance area. So far as the Dow is concerned, this looks quite bearish at this moment. We need to blast through a lot of resistance for this to get bullish. So this is something we're watching quite closely. On the weekly chart, gang, we are just in a huge symmetrical triangle. These two big blue lines. We're getting ready to come to a resistance point on it, which we need to break out, or we should hit and then head southbound. On the daily looks a little more bullish because we broke resistance right here. We're building a high base. Next area of resistance is going to be 12,384. So that would be an area of resistance. If we can pop up through that, that would be quite bullish. The Nasdaq, we have huge symmetrical triangle, and then we have an intermediate triangle inside, and then even a smaller one right here. So you cannot get any more pinched in the technicals than what you're getting right here. So technicals can lead the broad markets. We are watching the technicals like a hawk right now. Unlike what we're seeing on the Dow and S&P, we have not broke major resistance yet on the Nasdaq. It is relatively weaker, and it is coming into an apex of right here, the main trend lines of the or the symmetrical triangle. And you can see the moving averages, the 50-day moving average, 200-day moving average, the 20-day moving average, the 100. Price action is caught up in the middle of all these moving averages, which is a telltale sign that the markets are coiling, building strength, getting ready to make a major move, one direction or the other. If I go here to the weekly within triangle, within major moving averages. On the weekly chart, we're looking for a breakout or a breakdown, we're in a lot of trouble. I think if we get down here, let's see where this number would take us. If we drop down below 2470, that would be really bearish. But if we can get above 2680, that would be pretty bullish. I have alerts set on these areas for my own trading, and I do trade for an institution also, and I want to make sure that I am hedged in this market or playing it bearish if we start breaking down. Here is the Nasdaq monthly chart, lower highs, higher lows. Look at the pinching taking place, these dojis here. So this is a really powerful formation, and we are looking, I think this month will be the catalyst for a big bullish move up or down. And we do have a little bit of support on the monthly chart. If we get down here below, say 2440, if we get below 2440, that's going to be very bearish, but we really need to get above 2830 to be bullish. And if we need to clear this high also. Be watching that. And the Russell small caps, a lot of those on the stock picks that I do each week on the Stock Picks V newsletter are strictly coming, they're smaller type companies for the most part, because those give us the biggest movement, and we watch the Russells closely due to that. The Russells is breaking major resistance trend line right here, just like the S&P and Dow building a high base. It needs to pop here. I'd like to get it over the 200-day moving average, and that would be quite bullish if it can do that. So I'd like to see it above 765 or higher would be bullish. If we drop and we start breaking down below this trend line, I think anything under 700 would be very bearish. But it's going to be, if it gets to 700, if you see a drop from 750 down to 700, it's going to be bearish already. But if it goes below that, we're in a lot of trouble. The weekly chart here, it broke a resistance area. What was resistance is now acting as support. We rally higher. We have the 100-week moving average acting as support. We have major resistance coming up at 772. So we need to get above the 50-week moving average and this 772 area for the weekly to be bullish. So pay attention to that. And then as far as the monthly goes, it looks like the other monthly charts. Lower high, lower low. Look at this pinching. This dude is going to want to pop one direction or the other, and it's going to happen with a vengeance. Mark my words on that. Now, no one knows what is going to happen, but I've been trading for 14 years on the live markets, and I've been watching these charts. I probably arguably watch more charts in a single day than what you all do. And when you do that for this amount of time, you really start to get a feel of what's happening. And I wish I could make this into a 3-day video, and I would really explain to you why these patterns are poised for major explosions, one direction or the other. Again, let this be a major warning to you. Do not let this go, and make sure you share this warning with a friend, because you want to be protected on this if it starts to head south. And we'll keep you abreast of the latest on that. Now, let's get looking at some other chart formations. We're going to look at the bank, the financials, which is really important. Here's the daily. The daily looks strong. Boom. Breaking resistance. We're just below the 200-day moving average. We need to break this area. If this high base does break, getting over 1650, that would be bullish. On the weekly chart, we're at a major resistance area, gang. If you go back in time, right here, puts us in 2008. And from 2008, we dropped. We hit our head right here at 2011, May, right, July 2011. Come back up. We're there right now, December. Ended out the year right at a major resistance line. And if we start to drop, if we drop below 1600, that's going to be bearish. You should see a quick fall down here to the 1510, 1515 area. pretty quick. It should just drop right on down. But this is a big symmetrical triangle. We're looking for a breakout or a continuation breakdown to 1400 on the banks, which would be very bearish for the markets if that were to happen. Now let me show you a really crucial chart. We're looking at the bank monthly chart. If you go back in time, this 1370 is a major support area. So we have what's called a descending triangle, which is more bearish than it is bullish. However, triangles can go any direction, but studies show that this is more bearish than it is bullish. But if it does break this trend line, that will negate this bearish descending triangle formation, and it will go into some sort of upward trend. So this could be just a big double bottom and we'd see a rally come up, or we could even do a head and shoulder trend reversal pattern. So this is a big time important area. We have this triangle, it's pinching. If we break over this area, say if we get over 1670, that's going to be pretty bullish, gang, on the bullish side. If we start to drop below 1500, it should drop down below 1400 really quick. 1370, a major support area, but I'm going to say if it can get below 1300, the markets are in dire trouble. Mark that down. Now let's take a look at gold. A lot of you trade gold and you'd like to watch that and study it. Now I'm going to give you this big symmetrical triangle. This dude broke down with a vengeance. Big gap down, huge sell-off, big volume, a bear pullback to the 200-day moving average. It sells off again, popping back up here. So if you blow this up, really, you do not have what's called a banded baby candlestick reversal pattern because you do not have an open window here. You do have one here. So you have a small gap down, gap up, but these can be really powerful. We are in a falling wedge. So this falling wedge right here is more bullish than is bearish, and you have a bullish divergence here on the MACD oscillator. If this breaks higher, you could see a nice little run, but we have a lot of resistance with these moving averages and these two major trend lines. If I go to a weekly chart, it had a big symmetrical triangle. It did break down out of that. I do expect to see a little bit of a rally here, but the markets are in a lot of trouble, gang. A lot of trouble, or at least the gold is, because we're making lower swing highs, lower swing lows. We're in a downtrend. We're starting to break major moving averages. If I look here at the monthly chart, now this says it all. Major support in 2008, major support 2009, 2010, 2011. 2011 going into 2012, we're at a major support area. We should find support there because it's been proven to be support for a long time. However, if it fails that support, do not expect gold prices to remain at these high levels. You will see a significant sell-off that will pale in comparison to the sell-off you've seen here recently in the markets. So you've heard it here. We're watching the charts, keeping you abreast to the very latest and the very best of technical analysis on all major broad markets. Here at finviz.com, and basic materials here. This is going for the year, starting back here at January, going here to December, into January. Big symmetrical triangle, you can see that right here. But the markets, you can see, ended down minus 10.5% on basic materials. And we're below the 50-day moving average. You can see the 50-day moving average right here. Conglomerates, businesses, just above it, but it's down 4%. Consumer goods, up 2.6%. Financials is a huge one, which we just talked about. It has taken a major nosedive in the markets, down nearly 19%. So the financials are beat down. So if they rubber band back, which usually happens after a huge sell-off like this, the markets will respond positively to that. Healthcare up a whopping 10% for the year. Industrial goods down 5% for the year. Services up 4% for the year. And technology, is down 3.6% for the year, and utilities up a whopping 13+%. Not too shabby. Here are the groups. Utilities up 13+1%, healthcare up almost 10%, services in the green, consumer goods in the green, technology in the red. And you go down here and you see that financials down, knocking at the door of 20%. A lot of times when you get a major sell-off like this for the year, you'll see this bounce back, which is very typical after an extended run, one direction or the other. So it's something that we're watching and paying close attention to, and you should too. We are certainly more about technicals than we are economic things. However, just to highlight a few things, U.S. labor markets hardly budged this year. Economists are predicting that the December unemployment rate will likely hold steady at around 8.6%, and we do watch that. And that'd be down from the 9% rate that it started out at around 2011. However, GDP is currently at 1.8, which it dropped from 2.2 from the previous quarter. So all in all, we need a few things to happen. We need the economy to strengthen. The unemployment rate must shrink, home prices must rise, GDP must rise, the deficit must begin shrinking. It has to happen. And political spending just needs to be reined in. We need to quit talking about it and fighting about it. It needs to happen here in the U.S. And furthermore, the U.S. budget must be balanced. That has to happen. Speaking for myself, we're coming to election season, and there needs to be a change politically speaking, and it has to happen with a smaller government, period. We need to start making that happen because I think our government is suffering by this. I mean, not to mention the woes that are out there in the marketplace right now. These things such as the spike in energy costs relating to the Arab Spring or the after effects of the Tohoku earthquake and tsunami that hit Japan, and not to mention the debilitating debt ceiling negotiations that ultimately prompted the S&P to downgrade our debt rating here in the U.S. from AAA to a AA+. And I mean, the world is fearful of an economic meltdown in Europe. Portugal and Spain, now Italy, due to the Eurozone sovereign debt crisis that they're having. So there's a lot of issues taking place, and if we can get some stability taking place out there, the markets will respond positively to that. If we do not find that stability, the markets will react negatively to that, and the markets will drop. And the time is now. It will happen. We are in major symmetrical triangles. We're building up pressure, and the time for a major move to take place is knocking at the door right now. Many of you have your monies wrapped up with a financial advisor and broker. Studies showed this year that 75%, 3 out of 4 financial advisors did not keep up with the S&P this year. The S&P was flat. That means 75% of all market professionals are down in their portfolios. If you're holding mutual funds, you are taking a 3.3 to 5.5% haircut. So that's on top of whatever you lost from your broker. Why? Because mutual funds have built-in prices that you just never see. There's middlemen that help manage those funds. They are taking their cut out of it. The smallest amount is around 3.3%. 3.2% is more specific. The right or low number as high as 5.5 in mutual funds. So putting your money with financial advisors isn't necessarily the smartest thing to do. And furthermore, NASAA tells us that roughly 89% of all traders trying to trade their own money will lose money. So what is the answer? I believe it's just trading education, and we do that and do that very well here at freeonlinetradingeducation.com. We have everything you could possibly need or want Go here to the trading videos. We have multiple videos: stock trading, ETF trading, market video trading is the one like the video you just watched now, and the one-on-one trading courses. If you want to learn how to trade, it's a self-home study. You can do it yourself. It's free. Go here. It's 4.5 hours worth, 30 lessons, 5 courses. And then the chart school. Go through the chart school. You will learn tons in that. Then we have our premium services. Take the 201 courses. This course will make you a confident trader in the markets, and it's just a matter of time. You will be a mentor student with us if you want to get to that next level and start trading the correct way. Know that this is your next step. You want to do that. And we also, if you're a day trader, we have the Grok chat room. So let me share one last thing with everybody. As the owner and president of this company, I want to sincerely thank you for being a user and possibly even a student of the Grok Trade group. And I want to say thank you for being a part. We sincerely appreciate that. And from the whole team of us, I want to just extend that gratitude and thank you. So share us with a friend, and we look forward to a great 2012.